Good morning, everyone. Welcome to Your Money Matters. I am Angela Giroux, publisher of the Bauman Letter. And with me are Ted Bauman and Clint Lee. Welcome, gentlemen. Now, today we're going to take a look back. We are about a year, we're past a year now into this pandemic. We've seen, obviously, a lot of volatility, a lot of change. So we're going to dig into that a bit. I did want to mention, though, in speaking about this past year, Ted, we pulled some numbers, and your profit switch recommendations, both open and closed, beat the S&P 2.5 times. So congratulations, job well done. And these were certainly difficult conditions. I think.
And don't forget that Clint tells us when to pull the trigger. So
right, and thank you, Clint.
his entry points help. And I just want to point out, and I shared an article with you this morning, Angela, as you know, saying that 60% of large stock picking funds didn't beat the market this year. So you're getting a great deal here, folks.
All you gotta do is times better.
So, yeah.
I think we can all agree that is great performance. But what people seem to not be able to agree on is what exactly constitutes a recovery in light of this pandemic. Now, the Fed right now, they say that jobs is the focus. They're focusing on employment, not inflation. So, Ted, let's dig into employment a little bit and let's see if this is actually a recovery and where we go from here.
Okay, well, the background here, and I think it's important to remember that the Fed's comments are coming out of its policy framework, its mandate. For a long time, its mandate was just to manage money and keep the banking system stable. But then sometime back in the late 20th century, Congress, told them that they should consider employment and price stability as their two main goals. So what the Fed has done basically during this crisis is they've said, our main goal is actually going to be the employment part of it until we see inflation consistently that we think has got some sort of structural basis. In other words, they're not going to worry about if prices are higher in the second quarter this year than they were last year, because obviously the baseline is just completely out of line. So that, a lot of what you're hearing about inflation is actually misinterpreting what the Fed is saying. So let's look at the employment part. This is a chart that shows what happened to total US non-farm employees during the high point of the crisis. I mean, it just fell off a cliff. I mean, think about that. I mean, that's like more than 20 million people losing their jobs. I mean, 20 million Americans, and all of them with families and dependents. Now, it rebounded to about 143 million, but that's still 10 million less than where we were before. And so that's what the Fed is saying, that you can't ignore those 10 million people. They're more important. Their lives are more important than inflation, which I agree with. So here's the GDP piece, and that shows you that our GDP fell, but it has not recovered to the same trend line, or at least it hadn't up until recently. That's the second chart. The third chart is going to be showing you what the Fed tried to do. That's, the Fed knows that it's can only push on a string. You can't make people use low interest rates to grow the economy. People will use low interest rates to load up on growth stocks, as we've seen, but you can't make people make loans into the economy, no matter how hard you try, and the Fed knows that. So it takes government spending. So the next chart shows US federal spending and income over the last 12 months, or rather it goes back to 92, but it shows it's 12 months rolling. Look at the outlays. I mean, the federal government has just absolutely spent a tremendous amount of money over the last year in order to beef the economy back up. And it's done that because it recognized that it didn't do well enough after the great financial crisis. They learned that lesson, and the Fed learned that lesson. In fact, Powell was probably the biggest cheerleader during the last year for more government spending, the guy who's supposed to be worried about the sanctity of the dollar, so that tells you something. So this last chart shows what the current CBO projections are. It shows the dash line shows the CBO's projections for GDP growth. The small dotted blue line shows what would have happened with no additional stimulus other than what we got last year. And the green line shows you where we'll be with the Biden, the recent package. So basically what this tells you is that lessons learned here, folks. I mean, basically, It's very straightforward. You can call me a Keynesian if you want, but if one part of you take a sectoral view of the economy, if the private sector is not spending, somebody has to step in, or else you're going to have lower GDP and you're going to have fewer jobs. And the American political system has decided that we want the jobs and we want the GDP. So boom, here we go. Now, I know that there are questions of taxation and all that kind of stuff, but at the end of the day, you're not going to make your money back through taxes if you have a slow growing economy. So we'll see what happens from here.
Ted, you touched on tech stocks a little bit, but Clint, I think we should back up and take a closer look because it has been a wild ride.
Yeah, it certainly has been. I mean, tech stocks, as we know, and growth areas in general, I mean, those were the big winners coming out of the pandemic. And you really had two things going on to support that. You had sort of the collapse in interest rates that helped support the valuation case for tech and growth stocks. And then you also had sort of the shelter in place, the stay-at-home orders, and that kind of had the natural impact of boosting some of those other growth areas, remote work and how that tied into cloud computing or the demand that we saw with Zoom on down to e-commerce here as well. But I think the important thing to look at going forward is that what we saw last year with the interest rates and with growth stocks, that was just a continuation of a trend that's been in place for at least a decade, if not more, in the case of interest rates. And I'll highlight sort of those two areas as being, ripe for potential trend reversals as we go through this year. And so, why is that? Well, it's now because we're getting closer to a reopening and we've got yet more stimulus and we've just got all this pent up savings just waiting to be unleashed. And just to highlight a chart on that, here's a chart from The Economist. This isn't just a U.S. phenomenon. This is happening all over the world where you have this excess savings as a percent of GDP, as this is highlighting on here. And you can see for the U.S., and this is just through the first 9 months of 2020. So this doesn't even include the most recent $1.9 trillion package that was passed and how much of that just adds to that savings buffer. And at 6% excess savings for the U.S., that translates to over $1 trillion that's just waiting to be unleashed out there. And we'll see how much of that comes out, but that's fueling the inflation fears. And so that's, sort of the impact you start to see on interest rates. So let's talk about interest rates really quickly. This is a chart of the 10-year treasury yield going back to 1980. Interest rates for pretty much as long as I've been alive have been consistently falling throughout this time frame. I mean, it's a classic downtrend. I mean, it's lower lows and lower highs, and that's still in place right now. If you look all the way to the right-hand side of the chart, even though we've had this backup in the 10-year recently, it's really only retraced the decline that we had following the pandemic. So what I would look for to see this big reversal from this 40-year decline in rates is for the uptrend assert itself. And I would look at a move above 2.5 to 3% on this chart. That would take out sort of those prior highs. That would give me the sign that we are now in a more sustained rising rate environment. So that's one thing to look for, and that 0.5% low in the 10-year we need to hold there. Now, if that does happen, if we do keep seeing a sustained increase in rates, that's going to lead to another thing, and that's sort of this recent reversal that we've seen in the growth versus value trade. So I have a chart on that here as well. This is actually a ratio. So this has a growth ETF, IWF, in the numerator, and IWD, which is a value ETF in the denominator. So when this line is rising, that means growth stocks are outperforming value, and vice versa when it's falling. So that's why I say, what we saw with growth stocks last year is just a continuation of a trend that's been in place really for a decade now. So you can see that with this chart. This goes back to the start of 2010. And you see this consistently rising line indicating gross outperformance. But as I'm highlighting with the circle, we had this recent peak and we've fallen sharply off of that. That's coincided with this rise in interest rates. So these are two decade plus trends to keep an eye on with interest rates and with the growth of value trade. Those will be how that evolves throughout this year, especially with rates, and then how that impacts this relationship.
For those of you watching, Ted, Clint, you guys have given a ton of ideas on sort of how to play this rotation. But I would like to take a look back because it has been such a crazy year, let's take a look at some of the things that we've gotten right, and let's take a look at some of the things that we've gotten wrong. And Ted, I am going to put you on the hot seat. We're going to start with you.
Sure. Well, I'll cover what we got wrong. I'll leave it to Clint to cover what we got right.
Always appreciate your honesty, Ted.
What a gentleman.
It'll cost you, Brew. Look, the bottom line is, nobody has a crystal ball. I did not anticipate that there was going to be such a response to the low interest rate environment from March last year. My reasoning was that tech stocks were already overvalued. I mean, in my opinion, they were already overvalued, many of them. And to me, the notion that rational investors would bid them up even further just didn't make sense to me. So I made my famous call for a double bottom, and I was wrong. Although one could argue maybe it's just happening now. It's a long double bottom. Wide bottom, I guess you'd call it. But bottom line is, I didn't see that. The other thing that I didn't see was the speed with which Congress would shove money back into the economy, and that so much of that money would end up in the hands of retail investors chasing up stocks. Because let's not forget that a lot of what bid up the price of stocks last year was people with time on their hands, money in their pockets, and nothing else to do, and they bid up stocks. That's ending. So that and that is not something you foresee. So we didn't get that right. But I just want to make one comment before we go to Clint about what we got right. And that is that long-term scenario that he's talking about and whether we're going to see a trend reversal. I think this is the key issue. This is the issue. The reason why interest rates have been so low since the 80s is because we have had a consistently slow growing economy. Low interest rates reflect the fact that there just isn't much demand for real world things like capital and workers, because the economy has been so overheated for most of our lifetimes. And that's because of policy choices made at the federal level, particularly not to spend money and to be, austere. What we're seeing now is that's changing. The economists just came out and said, this is a big deal. This could be transformatory for the global economy if you have fiscal policy taking a big lead here. And yes, if we do see high interest rates, that's a problem for some investors, but it's great for the economy because it means that we're growing. People have jobs. It means we can make money in real industries rather than just in speculating on SPACs. You can really get burnt doing that, as we know. So I just wanted to throw that out there because I think this is a much more momentous shift that we're going to see this year than a lot of people realize.
All right, and Clint, we're going to go back and we're going to look at some of the winners. Can you highlight?
Yeah, absolutely. I mean, we, through our commentaries, our writings, or these videos, we've had well over 150 different picks out there. But, when I boil it all down, I mean, really, I think there's three key themes that really worked out in our favor. One was identifying the housing opportunity early on, especially right around the bottom of the sell-off after the pandemic.
Ted, you got heat for that one.
Yeah.
Interest rates.
Right. So that, early on in the pandemic, that was a great call with housing. In late summer, early fall, we started talking about the opportunity in the renewable energy sector. That's actually, one of Ted's picks from back then is our top performing Bauman Daily pick. And then also, in late fall and into the election, we were talking a lot about the cyclical rotation. Be on the watch out for the cyclical rotation, the factors that could make that happen. And, we've seen that come into play. That's only accelerated here over these last couple weeks or so. So, from a thematic standpoint, there's some great areas for us. And then overall, you look across all of our recommendations. I mean, we had since the bottom in the stock market back in March last year, we have a nearly 100% win rate with our picks. And if you start to narrow down from there, if I got some stats here, just looking at our picks, the relative performance versus the S&P 500, 55 of those delivered an excess return of 20% or more. 12 of those were ahead of the S&P by 50% or more. And then, as I mentioned just a moment ago, our best pick was ahead by more than 100%, is up about 133% versus the S&P up 23% since that recommendation was made.
Great work. And it's all free.
Yeah.
These are all free recommendations in Bauman Daily and the YouTube videos, which is a great reminder for everybody watching. If you do not subscribe to Bauman Daily, it's completely free. You just heard about our track record. There's a link below. But more importantly, if you want access to Ted's elite research service, Profit Switch, there is a link above and below, and you can get more details on that as well. So please do so. Ted, you are on a tear. And gentlemen, thank you very much. I'll see you next week.